You have identified the valuation of a stock is right and the debt is low, but is the business itself healthy? So hello everyone, I am Tamandeep and today we are going to learn about analysis of two operational matrices, sales concentration and inventory, and we'll expose a potential risk to the growth of a company. So today we are going to learn about two simple tricks. One, knowing how much a company depends on one of its product, and second, spotting an inevitable downturn of a company just by observing its inventory. Alright, so let's start with the first, sales. So isn't the logic simple? The sales increases, right? The sales increases, the profit increases. Profit increases, share price increases. It's simple, right? But by how much? Let's understand with an example. So let's start with an example of small company AMD. So in early 2017, AMD launched its EPYC servers, right? Serving server processors. So what happened there? The processors were a hit, by the way. So let's see what happened. So in 2016, it had certain revenue and it increased year by year as it launched the EPYC, right? So here is a chart. You can see that the revenue increased and became more than double in about 5 years. So the revenue increased, the profit increased. So now the stock price should increase, right? We know that by now. So this is the chart for the stock price. The stock price short. Look at the impact. And it started right here about $2 and it reached about $92. But now that we are looking at the stock price, it was way too exponential a growth, wasn't it? So one would expect the stock will fall soon, right? Let's confirm that as well. So you see, the profits increased and the stock shot up and it later fell. Not too much because the company was good, right? So that was a quick revision of the previous concept. So the point is the revenue increased and the stock increased. But let's take another example. But this time a big company, a large company. So Apple in 2024 launched its Vision Pro and it was an awesome product. Everyone bought it. So Apple has not really given us the proper data of its revenue by Vision Pro in 2025, but it was estimated about to be 1.8 billion USD. But the issue here is Apple itself has a revenue of 400 billion USD. So 1.8 billion USD over 400 billion USD. So you see here the Apple, even though it had another hit product, the stock price didn't really change its pattern. It's increasing, but it's steadily increasing already, right? There is no proper change in its pattern, and that's what happens. You see, it sounds very obvious, right? We need to know what is the percentage of the revenue increase when we see a hit product. AMD did not have any other hit product at that time, so its stock shot up. But Apple has many hit products, so another hit product didn't really matter much. And as obvious as it seems, it's pretty easy to miss. So always look up a company's segment reporting to find its sales breakdown, right? So let's move to the next concept, inventory. So for this segment of the video, let me start with the statement. So here it comes. For a company that sells physical products, rising inventory is the single greatest warning sign. that economy is low or company is going down. But isn't it counterintuitive? Bigger inventory, usually big companies have big inventories, right? So bigger inventory should mean that company is growing, but what's going on here? So let's imagine, let's say there is a company whose sales is going down, right? Let's say sales got slow. So profit is losing, products are not selling as much, but the production continues. See, everyone set up a factory and workers are there. So who wants to produce less products when you have a capacity of more products? So management usually are slow to slow down the production. So the production is continuing and the sales are low. So the stock piles up, inventory piles up. Stock as in product stock here, right? So the inventory piles up and slowly warehouses fill up. Now sales are already low. You don't have an option to buy more warehouses. So what happens? You have to give an untimely stock clearance sale, right? But such sales really reduce your profit margin and it really hits your product. So that's the issue here. Yes, big companies have big inventory, but we also need to make sure that this issue is not happening. So what is the conclusion here? So conclusion is the inventory growth should ideally be equal to or less than the sales growth. If sales is also growing, inventory is growing at an equal pace, it's good. Let's say sales is growing by 5%. It's good, company is growing. But the inventory is growing by 15%. It's bad, it's a red flag. So always keep that in mind. You can find inventory under the current assets of the balance sheet, right? So you need to monitor it quarter to quarter or year to year, depending on the company. So there you have it, guys. Let's conclude. So guys, the conclusion is don't just trust a stock based on its PE ratio or hype. Always dig deep into the operational matrices. And by observing these matrices, you will be able to spot a fatal error before it appears in the earnings. So guys, the secret is to ask the common knowledge questions. Is the new product big enough to move the needle? Is the warehouse piling up with the inventory of a product that is no one buying? Answer these questions and you will be happy. So that's it for today, guys. In next video, we'll focus on shareholders' rewards. Bye.